Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker, and with me today, I'm excited to have two people from Cove Street. Making his second appearance on the podcast is Eugene Robin. Eugene is a principal and research analyst over there. And then making his first appearance is Andrew Leaf. Andrew is a research analyst at Cove Street. Gentlemen, how's it going?
Good, thank you for having us on.
Great. Well, hey, Eugene, it's great to have you back. Andrew, it's great to have you on for the first time. Let me start the podcast the way I do every podcast, and that's by pitching you to my guests. People can go look at the first podcast that Eugene and I did on Viasat for a full pitch, but what I would say is Cove Street does great fundamental research. The first podcast we did, I thought was great. The response was really great to it. So it's just tremendous to have you guys back on. The first podcast got a lot of feedback, and I think people are going to be really excited to hear from you guys. So with that, let's turn it over and start talking about the company we're going to talk about today. The company is Viemed. The ticker is VMD. I'll just go ahead and do a disclosure that this is a little bit on the smaller side, around 350 million market cap. Cove Street obviously has a position in this, so let's just have that disclosure out the way so we don't have to worry about that. That said, Andrew, maybe you can kick us off. Why are you guys so interested in VMD, and what is it?
Sure. Yeah. So I'll give you the overview of the opportunity, and then we can go into the fundamentals, which we love discussing. So Viemed is the largest provider of non-invasive ventilators in the country. They do this in an asset-light model through a network of respiratory therapists. It's a great business with good margins, high free cash flow generation, good return on assets. But extremely underfollowed. This was spun out of a TSX Ventures company in 2017. And, at the time they had 50 million of revenue. But the interesting part is they're in a really, really high growth area. They're growing at about 40% CAGR pre-COVID. And we really like this opportunity because we see a pretty clear pathway for the company in the next, 3.5 years to double its EBITDA. And so, that would take the stock, which is trading around $10 today, closer to 18 in our estimation. And we think there's a large market opportunity for them. This is very small, and so they have a large runway. We're looking at, they serve about 7,500 patients today, where the whole patients that they could serve is about 1.25 million. So it is a smaller company, as you mentioned at the beginning, but the interesting part is there's just so much runway and so much market share and high growth of the actual market itself for them to grow into.
In terms of,
go ahead, Eugene.
I was gonna say where we found it, and we've developed like a small circle of competence, hopefully, around DME. There's actually, as a minor plug to anyone who cares about Microland, there's another micro cap called Great Elm Group, not Great Elm Capital, which is GECC, but GEG. And within it is a DME business that, it's actually on the CPAP side, so not the vents. But if you just did, kind of a private market value on that side alone, it's the entirety of the market cap. And then you get the various things, including $1 billion NOL for free. So that's my little plug there. And yes, disclosure, we do own that as well. But anyway, doing work on that is actually how we came across the parent company of this was just Protec, traded on the TSX Ventures. And then these guys spun out, and I just tracked them for a little bit. And eventually, we started to do a deeper dive because when they got and they converted from Canadian GAAP to US GAAP, there's some little nuances that were changed. But when they started showing clean financials, you actually saw the power of the business model come through. And that's actually where we entered and, kind of did a little bit more work on them and slowly over time kind of built up a position. So I'll let Andrew or either Andrew, either you, if you want to ask questions, or Andrew's going to be the pitch man here.
Great. Well, Andrew, I guess the first thing is, like you said it, this is ventilators at home, but what is the typical use case for when somebody, I think Medicare is their 60% of revenues, if I remember correctly, but Medicare comes to them, a patient comes to them, whatever they needed. What is somebody getting onto a ventilator at home? What's the typical use case for that?
Great question. And so the typical use case is for, it's late stage or stage 4 chronic obstructive pulmonary disease, COPD. So these are patients who have just really, trouble time breathing, and they need to be set up on this device in order to, this tends to be more closer to end of life, but this is to help them breathe, them be a little bit more ambulatory, and improve, end of life care. And this is particularly well served in the home, so you don't have to be in a hospital setting for this, so it's more comfortable. But the real reason why we got interested, and I think stepping back, we should go into what non-invasive ventilators are and how that industry sort of started.
Yeah, please go ahead.
So non-invasive ventilators, in the early 2010 range, was kind of brought to market by a couple companies, ResMed and Philips. And what the real efficacy of this product was that these late stage COPD patients were visiting the emergency room 4 to 6 times a year. And that cost the healthcare system anywhere from $50,000 to $60,000 annually. And they started putting patients on this NIV, and not only did it improve the patient's quality of life, it brought down the cost to serve that patient to $12,000 annually. And so there was not only real efficacy here, there was a large cost saving to the system. And so that got a lot of healthcare providers really interested in this device because it made not only economic sense, but also better service of care. And so as the market developed, people realized that this is best served in home. And so it really developed around home health as well, which was another large growing market. And for reference, and if you Google just YouTube non-invasive ventilators, the reason why it's served nicely in home, but you have to have a lot of services around it for setup, is because it's a pretty large setup. It's a pretty complex setup, not something you want to do over YouTube. As a patient, you really need someone in the house helping you do it. And so that's where the service component comes in. And that's why Viemed in particular we view more as a service company than a quote unquote distributor.
Yep, that's great. I want to turn back to COPD for a second. So, going on a ventilator is obviously, you're not going to do this if you're kind of normal or something, right? This is for stage 4 COPD, which my understanding is COPD, it's generally people who've smoked all their lives are going to get COPD. That's the vast majority of cases. And you're going on ventilator with stage 4. So I guess the first question is, these guys, I've read their investor presentation. They say, hey, COPD, it's later stage in life, baby boomers and that type of stuff. 10,000 new baby boomers every day. We're going to have a really growing market. I guess my pushback to that would be, hey, this is for stage 4 COPD patients, right? So what about stage 1, 2, and 3? What are the prevention measures? I mean, smoking rates are obviously going down. I don't think we're talking about smoking rates going down affecting their next 5-year runway, but I start saying, hey, smoking rates down. So in the long term, maybe there's less COPD patients. And in the medium term, if we can treat stage 1, 2, 3, maybe there are less stage 4. So there's less need for ventilators at home. So what are the alternative treatments that could prevent this? And how do you guys think about that risk?
So my response to that would be that, they're sort of serving the patients as they come in today and what we're dealing with in today's environment. While I think we should invest more in preventative care and help patients while they're in stage 1, stage 2, stage 3, our healthcare system's not really good at doing that. Our healthcare system's more good at, is better at serving the patient as the need arises. And so, as we sort of stated earlier, this is, a decently large patient set of 1.25 million. That's, by the way, 50% of late stage COPD patients. The other 50% don't necessarily have chronic respiratory failure, meaning they don't have to go into the hospital if they because their respiratory system's failing. And so, we view this sort of as a good way to serve that patient set. And, similar to, you can make, the same argument for dialysis, right? And you look at, the model of DaVita and those large companies, and it's just sort of where we are it's sort of the state of the country as it, as it relates to the health of the country, and they serve it as best as possible as it comes along. I don't know if
And
Eugene has something to add to that.
Yeah, I would answer that by saying that it's a degenerative disease. So by the time that you're in stage late 2 and 3, it's not about curing you. It's about improving the quality of life, right? And this is the key point here is NIVs. They're not going to cure anyone, right? It's more about, especially for stage 4, having a better, last year to 2 years of your life, right? And it's nothing, for the patient, it helps with, the terrible aspects of COPD, and at least gives them some respite, I guess, from the inevitability of death. And obviously from the healthcare perspective, from the system, if their studies are correct, right, and you reduce hospitalizations by like 42% or whatever they say, it certainly decreases the overall cost to the taxpayers. And I think that's really the key here is, and I agree with you, right? I mean, I think our generation is less likely to be a smoker. So all else being equal, is that a infinite funnel? The answer is of course no. But I don't, as far as I remember researching COPD, it doesn't seem like there's like a magic cure-all that forestalls the eventuality of where you are. Because with bronchitis and emphysema, as you mentioned, are like, you acquire those over 50 years of smoking. And so just because, I mean, you're just going to be in a very, maybe not as bad of COPD, but you're still going to have it. And they also make the point that while, the insurance carriers aren't really ready to apply reimbursements for earlier stage COPD patients, NIVs could be used for, stage 1, 2, and 3. Just how CPAPs, are sort of, preventative for people who have apnea and I'm on the borderline of having sleep apnea, right? So there's a lot of younger folks that use CPAP. So it's very similar in the sense that, it's more of an insurance cost calculation versus a lack of a growing market in terms of NIVs.
Perfect. Let me ask you something about the business model. So you guys mentioned, and I, again, went through their investor day, and one of the things they pitch is, hey, we are much more of a service model, right? We're going in, we're contracting with service people. They're going in their house. I think they even said like they're in there so much that they're almost a part of the family at that point, right? And they said, and I believe you alluded to as well, that's different than a lot of the people who they're competing with, who are more just, hey, we rent the ventilator to the customer and everything. So I guess my two questions there would be, A, how are competitors just kind of renting out ventilators? It seems like you would need someone to kind of service those ventilators. And B, how does their differentiated model, how does that play out, whether it's improved reimbursement, improved customer retention, NPS, whatever it is, but kind of just talking about how their model is differentiated.
Sure. So the company they spun out of was sort of it was a DME company that the largest competitors, Apria and Lincare, look like. And so it's probably better to start with what an Apria and a Lincare looks like. They are servicing physicians. So you go in and let's say a physician has a patient and they need, a ventilator, but they also need a wheelchair and some other home health items. The physician will refer them to an Apria Lincare and they will provide all of those needs. So they need to basically have the full line of products that anyone needs in home health, which is much more capital intensive business. You need to have distribution locations near hospitals so you can easily serve the patients all those products. Also, on top of that, the people delivering these products at home are not all the time respiratory therapists. Sometimes, if you're dropping off oxygen tanks or something like that, there's no need to have a RT, as they're called, drop that off. So Viemed's model is completely different. They're going into the physician and saying, we are only focused on this one patient set. One, they're educating the physician on why the patient set needs the NIV. And then two, they are fully servicing that physician and making it as easy as possible for that physician to manage that late stage COPD patient, which can be a harder patient set, as we previously alluded to, going to the emergency room 4 times a year. And so physicians love that because it's increasing the service of care, and it's also lessening the burden. It's putting more of the care burden onto Viemed and delivering it in a good way. And so it's a win-win. And so that's kind of their differentiator. It's that higher level of service, which they're able to deliver in a differentiated way because they have none of the legacy DME business model that they've got to also focus on. A salesperson for a legacy DME company has to sell a whole line of products and convince the physician to sign up for that, while Viemed only needs them to agree to the respiratory piece. And so we really think that's actually the differentiator and why they're growing faster than the market, one. And two, they're also helping expand the market because their RTs are going into hospitals where they're not using NIVs and actually educating the physicians on how to use them.
Perfect. Eugene, did you want to add anything there?
No, I mean, I think Andrew encapsulated it well. I'd say that in terms of growth too, their business model, I would, let's call it brick and mortar light, meaning Apria and Lincare and those folks typically set up little distribution centers. And I mean, they're not huge warehouses. They're literally, 4 walls and some people in them with some hardware, but they don't view the actual sale as a service sale. It's more of a equipment sale, plus you get for like PAPs and whatnot, you get like the resupply side, right? That's what everyone goes for, because in the end, the money's in the and this is how ResMed makes their money. It's not from the initial sale. It's actually from the ancillary things, the new mask, the new tube, the new whatever, right? And so the DMEs also act in that way. They consider the customer to be almost like a distribution endpoint as opposed to someone to service and care for. And I think Viemed does a better job at going to the physician and saying, look, we understand that you care about the quality of care, and reimbursement rates are, going towards proving out that you can actually help the actual end patient as opposed to just, charge for them. And so that's what we do, right? We send someone there, we make sure they're okay. We continuously ping them. We make sure they're in compliance with CMS regulations. That's the one thing that I think Andrew didn't mention, is that, in order to get paid for the first 90 days, you have to prove out that the patient is using the equipment the way that they're supposed to. If you can't do that, if there's no actual like real audit trail or kind of service model there, then you're going to get cut off from CMS. And that's a big pain in the butt for the physician. And so the way that Viemed competes too is saying, like, go with us. You don't have to, you just will never hear from whoever, ever again. And we'll take the patient over as our own. That they're in good hands because we care about them. And obviously there's a financial incentive for them to do so. So I think that's really the differentiator of the model. It's a minor thing, but it oddly enough, if you look at the way that the bigger companies behave, being that service oriented and focused is actually a significant differentiator and allows them to land. In terms of growth, I mean, they're now, I think they're licensed in every state, but they're, I would say 38 out of the 50, that's where they're real positioned. And then out of those 38, maybe only like 20 of them, they're really actually well distributed. So there's a massive runway of them landing, getting a respiratory therapist employed, trained, and then hitting the hospital market, and then kind of educating, and then finally getting that kind of lead gen and sales throughput that they've been really, really good at the markets that they started.
Yeah, no, I want to get into that massive runway in a second because I feel like I'm a sucker. Like, here's a company that's growing. They've grown what, organically 40% per year for the past couple of years, and this year they're saying, hey, because of headwinds, maybe we'll start off 20 and get back to 40. And I'm over here asking you about reimbursement rates and stuff. But I do want to ask a couple more there, and then we can maybe dive into the sexier stuff. So I guess my two other questions would be, one, their model versus a lot of their competitors is much more service driven. Are they getting better reimbursement rates because they're providing more service? Or, I've definitely seen this, and people have seen this in the past, CMS, Medicare reimbursement, it can be wonky. And it's like, hey, we're actually sending a service provider out to someone's house, improving quality of life versus the other guys just sending them a ventilator or whatever, but the reimbursement rate's the same. So are they getting better reimbursement because of their service?
So they are not. These rates are set by CMS, and they're not getting better rates. And to answer that question, so what the reason why their higher level of service has clearly in the physician's mind a higher economic value, and that they're winning by just sort of growing and gaining market share in what we know to be a unit economic positive model. So their low cost way of delivering this asset light gives them that competitive advantage where, they can still get the same rates as everyone else and still, have good economics, but then also win more revenue through that. So that's how we view it versus sort of getting into them providing more service and getting paid more, that they don't, and they don't need to do that for their economic.
Oops, I think we're losing Andrew a little bit. Eugene, do you want to hop in?
Yeah, I mean, I guess it's what he said. It's sad. I mean, it's an indictment of the healthcare system in general, but there is no differentiator in terms of what you get per patient versus someone who's less service intensive. And I think Andrew hit on the point that the point is though that they don't have any sort of additional overhead that one of the larger guys would have, and because the larger guys are effectively full scale, full service distributors, meaning like they have bedpans and wheelchairs and beds and whatever. And so if you don't have any of that, and you just focus on being a good service provider, it allows you to, as I mentioned before, differentiate on like the actual quality of service levels. But the little minor nuance here is because they're also constantly in the home versus like an Apria or Lincare, they can optimize their capital expenditures. And what I mean by that is, it's unfortunate that this is one of those weird industries where when we say churn, it literally means someone's passed away. So when customers churn, they actually take the equipment back and can refurbish. And so and they optimize and get better economics than some of the bigger players because their ability to kind of recycle and reuse and use the benefits of their route system to their advantage in the way that they do the economics of it and whatever. And yes, even though CMS doesn't care whether or not you're a good player, you can say that you provide service, but the quality of it, CMS doesn't differentiate. It's only a problem in the sense of maybe future reimbursement risk, right? Where CMS says, well, we don't think we're getting the quality of care for what we're paying, and so we're going to cut it, as they did in like 2016. Andrew will I think dive into maybe why that's a little bit different now. But so I think, it's unfortunate, but it is what it is. They try hard and they do better than the competitors, but they don't actually get better or any differentiated pricing.
Cool. So we've gone a little bit in the weeds, and actually I do want to talk Medicare reimbursement risk in a second and what happened in 2016 because I think it's important, but let's actually zoom out a little bit here, right? Like I look at this company, 300 million market cap, 350, whatever. Free cash flow last year, and I'm just defining this as CFO less CapEx, 22 million. They're targeting 40% growth. And not only are they targeting, they've actually been able to grow organically 30, 40% for the last several years, right? So when I look at this and I say something that's growing 30 to 40%, this company right now is trading at what, 15 times free cash flow? That's something you generally get that multiple if you're growing 0%, right? this thing's growing 30 to 40%. Is stuff that grows that quickly? Yeah, it's kind of CapEx heavy because they actually have to go buy ventilators and stuff, but they're putting up great returns on capital, great growth. I mean, if you just gave this number, if I showed this to a normal person, blind company valuation, they'd probably look at it and say, oh, that's a software as a service business that's investing a lot into hardware. And I would pay 80 times free cash flow for it, 100 times free cash flow for it, right? So what is the market missing here? Why is the market putting some risk on this company where they're saying, yeah, you're growing quickly. Yeah, you're growing with great economics. We think there's something unsustainable here. We're only going to value at 15 times free cash flow.
Sure. So not to segue into CMS reimbursement risk, but I think
it all ends up at CMS reimbursement risk.
Exactly. And so you kind of alluded to this already, but in 20 years for when they for non-invasive ventilators, and what happened during COVID was they were actually removed from non-invasive ventilators were removed from the bidding process, and so the pricing remained stable. And interestingly, so the way, for listeners, the way CMS bidding works is, it's called round 2021 of bidding. This was what was happening, and it's kind of, it's about a year and a half ahead of time before it goes to bidding. You figure out what items are on this list, and when non-invasive ventilators were put on this list, there was actually major backlash by the industry because of the efficacy of the product, and people think that people should be being served more economically in home. And what this resulted in, actually, and you can look it up, HR 4945, 180 legislators, both parties signed on and said, let's keep NIVs out of bidding. And so there's a real efficacy here where we think that it's being recognized by the market that this is, possibly could be excluded out of the next round, but is definitely excluded out of this round because of COVID. On top of that, if you look at this latest round, the first thing to be excluded in April of 2020 was NIVs, and then subsequently PAPs and oxygen were excluded after. And so this was sort of looked at as a higher efficacy product that's better for the overall healthcare system. And so it was almost immediately removed. I mean, April 2020 is pretty quick for CMS to move on that. And so we think that is probably the biggest underlying risk to the growth trajectory. But the counter to that would be they have the best economic model, they're asset light. And so, and not to mention, by the way, we didn't talk about this, but since they are the largest provider in the country, they have better economics. And so they can buy ventilators for, a large percent cheaper than mom and pops were buying in low volume. And so if CMS comes out in the next bidding round and really lowers pricing, their market share is going to rapidly increase because they're the lowest cost model, and they're going to be able to serve all these other people where unfortunately a lot of these mom and pops and regional players might go out of business, like you saw with PAPs. But we have a high conviction that they'll be the last man standing if that does happen.
Okay. So just real quick, I mean, in the end, you cannot dismiss CMS and pricing risk. I mean, the DME, the history of it has always been that anything that grows quickly gets pinged and put on the radar by CMS. And traditionally, they've done, some would say crazy things by saying like arbitrary 25% cut and just everyone eat it. They did that last to CPAPs, and that actually destroyed CPAP business models and effectively impaired a lot of people for almost a decade, really until from 2006 until maybe 2014. Those entities that were growing really quickly before that had just horrific problems and service issues going into business. But what CMS saw when they did that to the CPAP side was that the actual quality of care and the availability for specifically rural areas suffered, and they changed the way that they went about the price downs, right? And they did this competitive bid. The irony, of course, is the reason why they took out PAPs and whatnot this time around is because everyone came in at 30 to 40% higher bid. So the lowest clearing price was 30 to 40% higher than what CMS is reimbursing people today. And that's why they said, well, just kidding, guys, I'll just keep things as they are. And again, the reason why is because CMS does things, like I said, sometimes arbitrarily, but they're not stupid. They learn from prior mistakes. And I think the PAP side actually was illuminating for a lot of people within CMS, and say they had them say, look, we can't do this, or else people they're just not going to provide the care, and they're going to, I don't know what's worse, right? You get your cost savings, or you have a bunch of people who can't actually get access to the care because of the distributors and whatever went out of business. So that's one thing. And then I would also add that, and we didn't talk about this, but I think while Viemed gets the same reimbursement, that's also not necessarily true, because if you're more exposed to rural America, you get higher reimbursement rates,
yeah.
right?
Yep.
And that's one of those weird things that people don't think about, but even whether it's in broadband or healthcare, folks in the sticks get subsidized by everyone else, because it's just, it's impossible to build a cell tower so that you can get 5G coverage for 8 people out in the middle of Iowa. It's the same thing for DME. It's, they being CMS will not hurt rural providers as much as they would like someone who's in LA, right? And for better or for worse, Casey and team started in Lafayette, Louisiana, and their core markets really are, I don't know if Andrew knows the number, I forget what they are, rural versus urban, but they're not in like, the top 10 MSAs, right? They might be in Indianapolis, but they're not in like, San Francisco or Oakland or anywhere here actually. But so that's a little caveat that I just wanted to throw in there.
And
go ahead.
Sorry, real quick, just to add to that, because I think this is an important point. There's also a differentiator between NIV and CPAPs and BiPAPs, where NIV is more of a life and death device. This is extending life. This is, they just came out with a study. There's a 38% immediate reduction in risk of death with NIV. And so a lot of times CMS treats that differently than a device that, just improves quality of life, versus this is actually extending life and helping, this high risk category. And so while we have no idea what, the outcome of the next bidding process will be, or when it, we think that, as we mentioned, for a couple other reasons, it might be excluded. And if it's not excluded, we think this company is even nimble enough to deal with it as well.
Yeah. So, and then I just want to continue on the reimbursement risk. I think we've talked about, but I don't think we fully touched on so far. 2016, there was a big Medicare cut. EBITDA went from 11 million to 2 million. Revenue dropped about 10 million as well. I think it was 35 to 27 million. So, both EBITDA and revenue dropped 8 to 9 million. You can kind of look at that and say, oh, Medicare cut straight through to the bottom line, right? And I think your first thought is, when you look at that, you say, oh, if there's another Medicare cut, it's going to hit these guys just as hard. So how can I get comfortable that I'm not about to see all of my earnings wiped out from a Medicare cut? So I think you guys have addressed that point. I just want to make sure we talk about what drove the Medicare cut in 2016 and kind of why did they cut? How did their competitors, it is kind of interesting if they go from 11 to 2 million in a cut, but all your competitors go from 5 million to negative 10 million. That's pretty interesting, because I think you guys mentioned they can take share in that. So let's talk about the 2016 Medicare cut real quick.
Sure. So 2016 Medicare cut, as we've talked about, this was just sort of what you saw with CPAP and BiPAPs previously. And Medicare or CMS tends to look at the highest growing categories and indiscriminately cut pricing on the fastest growing segments, which makes sense because there can be a lot of issues with certain devices that might not be have high efficacy or just growing because there's a good sales team around that or something. And so again, with NIV in particular, we think there's a differentiated there's a difference here where it's a higher efficacy product for life and death. And the research we've done has shown that there is a lot of buildup, especially in Washington, to get this out of bidding next round. But again, that definitely will dampen, until we fully know what that looks like. It could dampen prospects and get people less excited about the stock. And so, to your point though, of what happened in 2016, a lot of it actually didn't really hamper the growth that much. A lot of for that year it did, but then a lot of people, reevaluated what the new pricing was, and then just made that economic model profitable. Viemed being one of those companies, still growing at 40% and regaining those economics. And so, the question always is if that same cut happened again, one that was pretty large cut, we'd think the next one would be less so and more manageable. But if that large cut happened again, you'd want to be with the most nimble asset light company serving this product. That's the one you want to invest in, not in the asset heavy company delivering those products.
So two things. One, we do embed within our expectation, even though there's like a 3-year window of status quo, we do embed a price down that's going to happen. I don't. Again, I think it'd just be foolish not to. I think investors should be aware that CMS will get to this area again because it is just such a high growth area. So that's one thing. I think the 2016 number was way too high in terms of, I think it was a blended 35% down. And CMS, again, as I mentioned before, CMS isn't stupid. They understand that when they did that, what it actually did to a lot of the mom and pop players, and who actually are, oftentimes the local DME provider, it destroyed their economics, and it was a big problem for them. And so speaking to the head of regulatory affairs at Apria and some other folks, no one in the industry thinks that would happen again, mainly because of the, I think, lobbying efforts from both sides of the aisle. This is again one of those weird things that Democrats and Republicans can actually agree on. So that's one thing. And then second of all, if you look at the revenue mix for the company and you just exclude the COVID one-time sale bump that they got this year, you get a sense of like, okay, well, these guys aren't going to take 100%, it won't be 100% flow through because it's no longer 100% about NIVs, the progression of vests, and I think 3 or 4 various other pieces of equipment they sell. I think over time, it's not, I think 3 years from now, while NIVs will lead the way in terms of growth, it's not going to be 100% flow through because they will become a little bit more diversified in their product offerings. And I think Andrew will go into again why this is so interesting, because of the route elements of it and the fact that they can technically bring a much bigger bag of stuff to sell to folks that have COPD, because there's a lot of other issues that they may have underlying that Viemed could be in a perfect position to offer up services for.
Cool. Let's build on this. So I have a couple more downsides I want to talk about, but I think this is a nice transition too. Look, we're talking downsides. This is a company that grows 40% per year. Maybe that slows down at some point because of a DME cut or something. But I do think there's also, hey, they're so focused on this one market, and you look at it and you say, I feel like there's probably growth bolt-on opportunities, and it doesn't sound like they're going to be distributing every DME, but these guys haven't really done an acquisition. I think they've got some technology that they're trying to start up. But when you guys look at this, how do you think about the opportunity here to go buy, they're serving a lot of COPD. I don't know, to move into treating phase 2 or phase 1 COPD patients, or, something else? How do you guys look at the growth opportunity and inorganic growth here?
We think there's a ton of opportunity for inorganic growth. They've got a net cash on the balance sheet, so they have no leverage, so they have the ability to do that as well. But to hit on what you just said, and what we think the really exciting opportunity here is for them to go into other subsets outside of NIV. So taking a step back for a second, because it's important to understand the model. If Viemed wants to enter a new state, they've got to get all the license, et cetera. But really, to start operations, they need to hire a single respiratory therapist. They drop ship a NIV to that therapist. The therapist then in their car drops off the item. I mean, that's how asset light it is. And they can, spin up greenfield business just that easily. And so they have the systems, the technology, and the operations to do that. And so if you could take that and apply it to, any other field, even, not just talking with a pulmonologist, but some other type of doctor and some other type of device, that's a really interesting model. And, if they execute properly long-term, 10 years, they could be just a home health company for, high touch devices. So we think that's really interesting. Now, shorter term, what that looks like is they actually just announced they're coming out with Viemed clinical services. So 50% of late stage COPD patients suffer from anxiety and depression. So they're also going to help serve those patients with, their psychiatry needs, and that can be delivered through not an RT, but a psychiatrist or another type of clinician. And so it's such a flexible model, and there's so many different ways for them to add on to it. We just think what they've done so far is so amazing, growing this quickly, this asset light, and are excited to see what they come up with in the future for, in that same sort of route model.
You mentioned they're an asset light company, and the way they grow is they go to a respiratory therapist. They say, hey, come work for us. The person signs up, they drop ship them a ventilator, and then the person goes to probably a pulmonologist and says, hey, give me your COPD patients. I'll sign them up. I'll do everything. I'm going to give them great care. And that's how they grow. I guess, why does a respiratory therapist come to work with them? And, what's to stop you and I, we look at this business, we say, hey, it's growing 40% per year. I mean, we just go buy some ventilators. We go on LinkedIn, we look up everyone who's working for them, and we go to the respiratory therapist and say, hey, we'll give you a 20% pay bump. Here's a ventilator, go to town. And we kind of poach some of their business that way. So how are they grabbing them, and what stops people from poaching them?
So that's a great question. So they are, they organically, just through normal recruitment processes, bringing on RTs that either have a presence already in the space or in the geographic area, or they are building a great reputation in the field for highest service, highest patient care, and so that's attracting new RTs as well. What's sort of their moat, and why, if we went to go and poach an RT from them and get them to service a patient. Well, one, we need the license and certificates for that particular state. And so that's why you see a lot of large regional players, or state players and mom and pops, because there's a capital, you've got to put some capital up front and some time to get those certificates and licenses. Number two, we would be paying a lot more for that ventilator than they are. They're the largest distributor, even though we think of them as a service company, of these devices. And so we'd be paying up a lot more for those devices. And then thirdly, and we actually haven't even touched on this yet, one of the most interesting part of their models, which you don't see at a lot of other DME companies, is once the device is delivered to a patient and that patient no longer needs it, they can send that back to headquarters or wherever they refurbish these ventilators, completely refurbish it. They break it down completely, clean every piece all up to standards, and then send it out again. And so now you have a 6,000 piece of equipment that you paid for up front that you're now using on multiple patients. And so
why is that an advantage? Like, why couldn't, again, if you and I started that, it seems like that would be an obvious thing for us to do. You know, I kind of think of Elon Musk with SpaceX, where NASA was sending rockets into the air and then they never used them again. And he was kind of like, hey, that's a, you know, $2 billion piece of equipment. Why don't we just land it and try and reuse it? And it seems to me if all of their competitors aren't reusing their ventilators, it's very similar to that. So why is that an edge for them?
So why it's an edge for them on top, it's two sort of different questions. So why it's an edge for them compared to their competitors? It's an edge for them and compared to their competitors because they are only selling this device which can be used across multiple patients, while their competitors have to sell devices that are single use or that cannot be refurbished. So that's why we say asset light. They're heavier CapEx because they've got to pay for these products and then maybe get a little sale, or lower margin sale, and then can't refurbish it. And then why, you know, you and I couldn't do it. We could, but there's a certain amount of scale you need to justify the spend of, having 6 technicians full-time refurbishing these. I mean, let's say, if we had, 100 patients or whatnot, how many, you might have one technician that's not being utilized that much. And so as you scale more and more, you get a lot of different benefits.
That's a really interesting point. So their scale lets them hire a technician who can then refurbish those things. So their scale enables them to get the technician who can then refurbish. So a startup can't hire that technician. They don't have enough ventilators. They don't have enough things to support them. They can't do the refurbishment. That's super interesting. Eugene, did you want to hop in here at all, or can I keep kind of moving down my question list?
Keep going.
Okay, great. I guess my last question, a long time ago, I worked for a private equity shop covering healthcare. And I always had 2 red flags that I remember going to investment committee, and it had just been beaten in our heads so much because we'd always see bankrupt companies in the Medicare reimbursement phase. And the first red flag was if their EBITDA margins were approaching the mid to high teens, that was always signs for a Medicare cut was coming. I think we've addressed Medicare cut. These guys are approaching mid-teens. I think we've addressed that, so we don't need to talk that. The second one was a really high bad debt expense, right? Because if most of your revenue is coming from Medicare and you're having a really high bad debt expense, there could be something. I'm not saying there could be something. These guys, and they've addressed it, they said, hey, we typically do 10% of revenue as bad debt. I've heard them on the calls. People say, why isn't it 1 or 2% given how much Medicare exposure? They've addressed it, but I was hoping you guys could just go a little bit further into it because that red flag just really always sticks up to me.
I would just say that if you go across the DME world, and whether you look at Adapt Health or, Operate is a little bit different, but PTQ, talk to Great Elm, talk to a couple of privates, then typical numbers are between 6 and 10. And just it is what it is. Obviously, there is a higher probability that the average, customer here is of a lower socioeconomic background, and a higher likelihood that some payments aren't going to be made because there's still a copay, right? The co-insurance issue here, that even if you are covered, even if you have private health insurance or whatever, you're still not going to be able to pay for even the co-insurance side. So it is what it is, right? It's part of the cost of doing business, and it's included within their financials. I think, for modeling purposes, just listen to what they say, and I don't think they're trying to hide anything. It's funny when under Canadian GAAP it used to be broken out, but now they report net numbers because US GAAP doesn't allow that. So you can just assume that it's fairly consistent. You can go back and 5-year history and see that it doesn't really bounce around a lot. I know there's certainly you could do some tricky stuff with revenue recognition if you really wanted to, but they've never taught, and the CFO there, that he doesn't. There's no indication that they're like that. And obviously, one of the key things that you can track is just the cash flow conversion ratio between EBITDA is reported, and from their cash flow from operations. And I think any sort of divergence would signal they're messing around with the accounting, and I haven't seen that. I don't know if you have anything else to add.
Look, that all makes sense to me. I just, my old investment committee, that would have been the first question that would have come up, and I couldn't not ask it because it's just been ingrained into me so much. Let me quickly on COVID. Look, you can't say these guys are doing ventilators at home, right? And obviously COVID has had an impact. They've talked about, I believe they do some stuff with contact tracing as well. You guys have mentioned it. I think COVID certainly helped them. They probably got some relationships from COVID just because they had ventilators, they had experience with ventilators. I think they were sending some technicians to teach hospitals and stuff how to use ventilators and stuff. So obviously that's a one-time bump, but I think it could create a little bit of extra sustainable value just from those relations, everything. I'm probably making this more of into softball than I meant to, but maybe just quickly address how COVID impacted their business top and on the upside and downside, and how that will impact them going forward.
It's a great question, and I'm glad we have a chance to address it. For anyone who's looking at the financials, so essentially what happened last year is they have a lot of ventilator equipment, and they break this out in their sales, and you can see a massive bump in just equipment sales. So they were just purely selling this equipment to hospitals or anyone who needed it during the height of COVID. That was mainly in the first 3 months of COVID, where they did the majority of those sales, and that it helped. I mean, that expanded margins a bit, and that also boosted sales a ton. And so the way you really have to look at this is, look at the core NIV business and economics and sort of ignore that one-time equipment sales. It was great for cash flow generation for last year, but we're not expecting that going forward. Interestingly, and this is why if you look at what the expectations for 2021 is and why revenues are down, partially it's down because they don't have those equipment sales. But if you actually look at the organic patient growth over the past couple quarters, it's actually been pretty stagnant. And the reason for that is because there's main sales points in the hospital. And a lot of these hospitals have been shut down, and they haven't been able to get to that sales point and educate those physicians on, or pulmonologists on, NIVs. And so there's also a kind of a buildup here, sort of this loaded spring of they're still hiring RTs in new geographies, onboarding them, getting them up to speed on how to sell, on how to explain the product, but they're sitting and they can't get into the hospital. And so once the economy reopens up, they're going to have and you read through their earnings calls, they're still hiring these RTs. So they're gonna have all these RTs that they didn't have before pre-COVID. And, if those ramp up to, what a normalized RT serves, number of patients that a normalized Viemed, RT serves, the continuation of growth will be massive. And that's what we're really excited about. And so there actually is an interesting part here where it's a COVID economy reopening story, because the main place where they get people to get onto the product has been shut down for a while now.
I want to be cognizant of time because we're approaching an hour. I think we've done a nice job here, but I just want to end this with one question, and I'll let you guys kind of wrap it up with last thoughts. But at the beginning of the show, when we were opening up, I think you guys said, hey, we think this could be, you mentioned $18 on the stock. I can't remember the particulars of it, but you said $18. And hey, nobody's going to complain about $18 if it hits that, because the stock is a little under 10 as I look at that. If it hits 18, I think there's going to be a lot of very happy people. But I do look at that and I say, again, 15 times free cash flow right now. We're talking 30 to 40% organic growth. We discussed really accretive acquisition opportunities at some point, all of these different goodies, right? And obviously there's the CMS risk, all that type of stuff. But I just want to ask you guys, when we're talking a reasonable bull case, why are we talking, why did you mention 18? Why didn't we mention 40? Why didn't we mention 35, something like that? And again, not trying to be too softball, but I did want to ask, what is that coming from?
So we're looking in the, medium term for that price target. Why we're excited and interested in this business is the longer term. We view this as a potential, what we call compounder, of a business that generates high free cash flow, and they can take that free cash flow and reinvest it in the business at a high rate of return on invested capital. And that's sort of the holy grail of investing, because if they can do that and find the outlet for that capital and invest that at a good return, 18 would be 3 years. There could be a lot higher price, 5 years, 10 years down the line, and this could be a multi-bagger opportunity. So that's what we're thinking much longer term, but we don't want to get too excited about that, because we're focused on the nearer term opportunities they have, but we're pretty excited about longer term prospects too.
Fantastic. Eugene, go ahead.
Yeah, I'll just say that due to the CMS factor and their current form, I don't think it would be fair for anyone to expect that $35 value. However, and Andrew kind of hit upon this, what they're trying with, as an example, the behavioral health, right? They're trying to create new markets for what I consider to be their route system. Because to me, this is just a route service entity that happens to have an equipment or hardware component that they use as a way to acquire potential clients. But in essence, what they are is a service and route business. And what else can they do? That is the great unknown. I know we haven't mentioned or talked about the people side here, but I think it's an important thing to look at. And Casey and his crew have done all of this organically, and it's very rare to find entities nowadays that don't rely on roll-up economics, especially in DME, to kind of to show investors like how good and smart they are. These guys are scrappy. They've done wacky things before. They try things. They fail at some things. But that's who they are. They're entrepreneurs, and they're positioned pretty well for where, if you think about where healthcare is going, getting people out of hospitals, keeping people out of hospitals, minimizing the costs to the overall system. There's so much that they can do if they have the footprint within special, these geographies, because again, a lot of them are rural, and a lot of those rural geographies do need a lot of, kind of more hands-on servicey approaches versus trying to get people into the hospitals, which are failing rapidly in many parts of rural America. So, there's just a lot of, I would say, not on the spreadsheet optionality that's embedded within their actual business model, that it's very difficult to say like, oh well, I think they're going to be X. We know what we know. I think we have a pretty good understanding of where the NIVs and their the percussion chests and vests, and the various other kind of PAPs and whatever else that they sell. We understand that business. We understand the risks of it, and I think we can get a pretty good approximation of fair value. What we can't tell anyone with any degree of certainty, other than to say like, in Casey we trust in terms of his scheming and ability to run much faster and better than the bigger guys, is that what else can they do? What else can they do with that customer list? What else can they do with the physician touch points that they have? What else can they do with the hospital touch points that they have? I mean, it really, if you think about it in a long-term perspective, this could be an incredibly interesting business in many, many different ways. So
yeah, as we come to the end of it, I look at it and I say, hey, when I was prepping for this, I was focused on Medicare risk and all this sort of stuff. And again, maybe I'm just missing maybe not just me, the market, everyone is missing the forest for the trees. Like, this is a 30 to 40% growth business that, it's led by its founder, and they've grown to over 100 million in sales through completely organic growth. It's like, if this was a software business, every person on Twitter would be just lavishing this company with praise and everything. And I think maybe it's because it's headquartered in Lafayette, which I'm from New Orleans. I love Lafayette. I've been out there. There's some great food out there, but founder, owner, operator trading at 15 times cash flow, 40% organic growth. Like, kind of surprising you're not hearing anything more about that. Again, got to be cognizant of time, but I want to get, is there anything here on the downside, upside, anything that either of you, Eugene, I'll start with you and then I'll turn it over to Andrew. Either of you kind of wish we had, or you just want to leave the listeners with as a parting thought?
No, I think we look at our investments through the lens of business value and people. I think we spend most of this time talking about the business fundamentals. The value is what it is. I think on a returns on invested capital basis, it's a very good business, and the value is, I believe, and at least this is our investable premise, that it compounds, right? As they add more products to sell, as they add more services to sell, as they increase their overall footprint by dropping down to new locations, that runway is so immense that, again, they're pipsqueaks, right? We're talking about, a fly on, not even the horses, like a mountain's ass, right?
Yep.
This is an incredibly small business with motivated, incentivized people that care a lot and have shown themselves to be pretty good stewards of capital, not doing anything stupid. They're dabbling in investing in some software, but that software actually is it helps with customer acquisition. So I look at it as more of they're just scrappy. They do very interesting things. They think about the long term, and honestly, I think they won't be around in a public sense in 5 years because one of the bigger entities will eventually gobble them up, and it'll be unfortunate, I think, but I don't know. I think that just the business value and people, the P side, it's everything lines up to be favorable in terms of a risk reward profile for this business.
Andrew, did you want to add anything there?
Yeah. So the one thing I'd like to add is, at Cove Street, we are value investors at heart. And so it pains us to sometimes, find a 30 to 40% grower and, because normally, as you mentioned, it's not trading at 15 times free cash flow. And so, it's weird for us sometimes to come on and be like, oh, look at this 30, 40% grower, when normally we're looking at things that grow significantly less than that.
3 to 4%, yeah.
Exactly. And so, classic growth at a reasonable price, I really think, sort of a GARP investment of, here, and that's what got us interested. Just the execution here, to be able to grow something this quickly organically. We see a lot of future value that you don't really have to pay for today. And so that really sums it up. We're not looking to invest at 80 times free cash flow on a 30, 40% grower of software. But this is more in our wheelhouse.
Perfect. Well, guys, this has been so much fun. I would say, I feel like I was so focused on the Medicare risk, but you guys have done such a great job of alleviating that. And again, 30 to 40% growth, 15 times cash flow. Andrew, great to have you on the podcast for the first time. We'll have to have you back at some point. Great to have a fellow Andrew on. Eugene, we've done Viasat. Now we've done Viemed. Maybe we could do Viacom next time. Maybe we could do VMD next time. We'll just keep the Vies going. Yep. But great to have you on for a second time. Appreciate you guys both coming on and look forward to talking to you soon.
Thanks, Andrew.
Thanks again.